Hey everyone, welcome to this explainer. Today, we're cracking open a really fascinating financial detective case. We're going to take a very close look at a company called ESNT. What we've got here is honestly a classic Wall Street mystery. There's this massive, head-scratching discrepancy between what the market is currently asking you to pay for the stock and what the underlying financial data suggests it's actually worth. It's a story of numbers, valuation, and market psychology, and we're going to unpack all the evidence together.
Okay, let's dive right into this. We're setting our baseline at $60.03. At the time of pulling this data, this was ESNT's last close price. Basically, if you wanted to buy a single share, this is the price tag the market has slapped on it. Seems straightforward enough, right? But hold that number in your head for a second, because it's about to collide with a completely different reality.
$226.01. I mean, wow, right? And this isn't just some random pie-in-the-sky guess. This is actually ESNT's mathematically calculated discounted cash flow fair value price. By projecting the company's future free cash flows and discounting them back to today, the math suggests the stock's intrinsic value is dramatically higher than its current $60 price tag. That is a visually shocking gap. And honestly, it's the entire reason we're doing this explainer today. How in the world can a stock trading at roughly $60 have a calculated fair value of over 226?
So to see if the hard data actually backs up this sky-high valuation, we're going to navigate this step by step. We'll look at the price versus value mystery, peek under the financial hood, examine their profitability engine, see how they're rewarding shareholders, and finish up with growth trends and our verdict.
All right, part 1, the price versus value mystery.
That crazy gap between $60 and $226 gives us this striking number, a 73.44% margin of safety. Now, translating the Wall Street jargon for a second, the margin of safety is essentially an investor's buffer. It means that, based on discounted cash flows, ESNT is theoretically trading for just a mere fraction of its true worth. You're basically getting a 73% discount on the calculated underlying value.
But here's the, multi-million-dollar cliffhanger question we absolutely have to ask. Is this a massive, genuine discount created by a totally inefficient market? Or is this a value trap, meaning a stock that looks cheap on paper but is actually fundamentally broken underneath? To figure that out, we have to stop looking at the price tag and start looking at the actual company.
Let's move on to Section 2.
Under the financial hood.
Now, what's genuinely fascinating here is how consistent the valuation actually is. You'd probably expect a stock with a 73% margin of safety to have just suffered some catastrophic drop in its valuation multiples. But look at the numbers. The current price-to-earnings, or PE ratio, is 8.71, which is incredibly close to its 3-year average of 8.47. The price-to-book ratio sits perfectly at 1.00, almost identical to that 1.04 historical average. This tells us the current low valuation isn't some sudden anomaly. It's literally just how the market consistently prices this company.
So, what about debt? A really cheap stock is often, a highly indebted stock. But ESNT boasts this incredibly low debt-to-equity ratio of just 0.09. That means for every dollar of equity, they hold a mere 9 cents of debt. Combine that with a current ratio of 2.77, meaning they have nearly 3 times the liquid assets needed to cover their short-term obligations, and you are looking at deep balance sheet safety and just supreme liquidity.
All right, so the company is clearly financially stable. They're not drowning in debt, no liquidity crisis in sight. But does a safe balance sheet alone justify a discount of this size? Well, not necessarily. A company can be totally safe, but still be completely stagnant. We really need to know if they're actually effectively generating profits.
That brings us to Section 3, the profitability engine.
Okay, this is just a staggering metric. 100% gross profit margin. Literally, 100%. That means their core service essentially costs them nothing to deliver on a gross basis. They don't have the heavy manufacturing or physical supply chain costs that typically just eat away at revenues before they even get to operating expenses. That is an absolutely incredible baseline advantage for profitability.
And the downstream effect of that perfect gross margin, it is massive. Check out the net profit margin, 56.54%. That means for every single dollar ESNT brings in the door, over 56 cents drops straight to the bottom line as pure profit. Throw in a really solid 10% return on invested capital and a 15% free cash flow yield, and you are looking at a highly efficient corporate machine. The numbers absolutely do not lie here. ESNT generated a massive $848.6 million in trailing 12-month free cash flow. It's undeniably a cash-generating engine. But that brings us to our next critical question. A company can hoard cash all day long, but how do they actually treat the retail investor? Do they share this wealth?
Let's find out in Section 4, Rewarding the Shareholders. Let's break these metrics down real quick because they are super compelling. The current dividend yield is a totally respectable 2.33%. But the real story? The real story is the growth. They have an aggressive 5-year compound annual growth rate of 16.90%, and that's backed by 7 consecutive yearly increases. If they keep up that exact pace, a buyer today would see their yield on that initial investment jump to over 6% in 10 years.
So the most crucial point here is their payout structure. Despite that really aggressive 16.9% dividend growth, ESNT only spends 18.36% of its earnings on those dividends, just 18%. The remaining 81.64% is retained. This leaves a massive financial cushion. It means the dividend is incredibly safe and they have plenty of room to keep aggressively raising it or, reinvesting heavily back into the business itself.
Okay, so we have insanely high margins, a literal fortress of a balance sheet, massive cash flow, and these super safe growing dividends. So we got to address the elephant in the room. Why on earth is the year-to-date return sitting at a negative 7.10%? I mean, if the metrics are this good, why the recent stock slump?
Section 5, Growth Trends and Verdict.
Let's see how this all builds a picture of market behavior. Look at the sheer magnitude of this historical volatility. Back in 2020, the stock dropped over 15%. But then, in 2023, it rocketed up over 38%. Currently, year-to-date, it's down about 7%. What this visually demonstrates for us is that double-digit swings are entirely normal for ESNT. The recent slump isn't some historically unprecedented crash, it's honestly just standard behavior for this specific ticker.
But the real clarity hits when we contrast the short-term noise with the long-term reality. Sure, over the trailing 12 months, net income growth shrank by about 5.5%, and the stock is down 7% year-to-date. But zoom out for a second. Over 5 years, net income has steadily grown at nearly 11% annually, and over a 10-year period, the stock has delivered a massive 231.73% total return. The short-term picture shows a slight contraction, yeah, but the long-term picture, that shows a decade of dominance.
Which brings us right to our conclusion. We started this explainer with a mystery, right? A $60 stock with a calculated fair value of $226. We've seen the pristine balance sheet, the crazy 56% profit margins, and the heavily covered dividends. We've also seen the recent net income dip and the standard stock volatility. So the question I'm going to leave you with to ponder today is this. When presented with a 73% margin of safety based purely on cash flow, is the long-term potential of the underlying business worth riding out the market's short-term volatility? Thank you so much for exploring the data with me today.